Okay, I'm now live. Yeah, I'm live. Okay, cool. Give it a few seconds. What's up, guys? Today we'll be having Keelan join us, who is a finance blogger. He's a finance blogger and he's also a management consultant, right? So he's going to be joining us for today's conversation about investing specifically in the stock market. And as I mentioned before, he is a finance blogger and he'll be joining us with his page that is called For Interest's Sake. So let me just give him a few seconds. There he is. Keelan, could you please request to join me and let's kick it off. I'm sure today's session is going to be really, really great. I'm going to enjoy it. I'm going to enjoy it myself. I plan on asking as many questions myself I can learn because at the end, this is a learning experience for all of us. And let me invite him since For Interest's Sake add. Okay, cool. And Keelan is a management consultant and he's also a finance blogger, and he's going to be joining us today to help us break down the investing in the stock market for beginners so that we know exactly where to start and where to go. Keelan, how are you, brother?
Hey, Nhlaga, how are you? I'm really good, thanks.
I'm good, thank you. So, for those of you who don't know you, could you just briefly introduce yourself? And actually, one question that you might as well kick off with is why did you start the articles? Why For Interest's Sake?
Sure. Look,
Yeah.
I think yeah, I think it's a great question. So maybe just a little bit of background about me. I grew up in Durban. I moved to Cape Town to study a Bachelor of Business Science in Finance and Economics. After graduating, I
Mhm.
moved to Johannesburg to become a management consultant, and I work in the banking and insurance industry, helping them essentially solve problems, do a lot of analysis, crunch numbers, that sort of thing. And, I've always been passionate about finance. That's why I studied what I did. And,
Mhm.
once I started earning a salary, I really wanted to be intentional about what I was doing with this money. How am I going to make sure that I'm not gonna for life rely on my income, but from working 8 hours a day. But how can I make sure
Yeah.
that I'm able to support myself outside of, just the day job that I have? Just to have options. And so the more I started finding out all of these things for myself and crafting my own financial journey, I would start discussing these issues with my colleagues and with my friends. And I just found that
Mhm.
there was, really a natural interest. And I was amazed by how many people were on the same journey, but also didn't know where to start and didn't really have information about how to manage their finances. And so I thought, if the small group of people I'm sharing the information with are really enjoying and benefiting from it, then why not share it with everyone in the country? And so forintersake.com is really just that, right? It's me on my personal mission to share broad knowledge with everyone in South Africa.
That's great, man. And what I actually realized as well in what you just said is that you you know people who are in the industry, people who are have studied finance and that kind of route, but aren't really familiar, aren't really sure exactly what it is
100%.
to get started investing. Because personally, I studied accounting and graduated in accounting here in Joburg, and then I realized though, as much as I did the accounting route, but there's not much that I knew about investing in the stock market, where to go if I want to invest my money, and is it something that I can even do myself, or do I
Hmm.
need a professional to assist me in doing that? And I realized that was actually a question that was brooding in the minds of many people. That myth, I guess, of saying that I don't have any money or I don't have a lot of money. So where do I even start to invest? How do you answer that question?
Yeah, exactly. So I think, a lot of people are quite intimidated by investing in the stock market. A lot of people think you need to be a professional to do it, or that you need to have a lot of money just to even get started. And some people don't even know where to go, even if they do have the money to get started. And so, right out of the gate, I would just say that investing, whether it be in the stock market or any type of investment, really is for everyone. And the stock market, I think, is particularly appealing because it's something that really doesn't require a lot of money for someone to get started. And so I say, even if you've got 100 Rand to invest in the stock market, and as and when you have more money available, you can just build up your portfolio piece by piece. It doesn't take a lot of money to get started. And there's lots of amazing products out there. If you don't know how to research good companies, or you don't have the time to look into the companies that you want to invest in and follow them on a daily basis, and you don't have a lot of money to maybe build up a whole diversified portfolio. There's great products like exchange traded funds, which, I mean, you can buy an ETF share for as little as 20 Rand. And I think not many people are aware of how cheap the prices are and how little money you need to get started.
But then how do I, like, because I'm thinking about it, how do I now like get in? I want to invest in shares because now when you look at it and think about it, if I'm not someone who doesn't really have a lot of knowledge about investing, firstly, I'm not going to know. And the question that I've received quite a lot is, okay, I want to invest my money. I'm ready to invest 100 Rands per month, but what share must I buy? I don't know what is a good share, what is a don't know where to put it. Should I just go put it in Apple, or should I just go put it in Baldwin? Should I, like, where do it's I think it comes down to maybe a bit more understanding that build up a decision of you to invest in a certain company. And if you're not sure, do you then just go for an ETF rather?
Yeah, so I mean, look, there's a lot in Schlager. Maybe let's sort of unpack it,
Just break it down.
step by step.
Yeah.
So if I'm brand new to investing and I want to buy my first share, what do I need to do and how can I do it? So firstly, you
Yeah.
need a broker's account. Okay, a broker is simply someone who takes your money and who takes your order to buy or sell a share. They take it to the stock exchange and they buy the shares for you. So you need a broker's account. And a broker can be with a bank. So Standard Bank has online share trading. There's apps of stock broker. You can have an independent broker like maybe Brand Swiss or Anchor Capital stockbrokers. My personal favorites is Easy Equities. And I mean,
I
they
like
don't
the
pay
fact
me
that you've
anything to
just
say
given
this. I just really, really
everyone.
love the product, and I tell everyone I know about it.
Yeah. Yeah. I'm saying that I really like the fact that you've
So
just given us a very wide range, a very broad range of products that could potentially be used, brokers that could potentially be used to buy and sell shares. Yeah, cool. Easy equities. I also use them. I really love them.
yeah, no, look, you and me both, right? Easy equities are phenomenal, and maybe I'll do an unsolicited sales pitch for them in a little bit. But maybe let's just stay on track, right? You need a broker's account.
Sure.
So both of us agree Easy Equities is a wonderful platform. Once you have a broker's account and you've registered and you've set up your account, you've given them all the details that you need. So that's like proof of your bank address, your copy of your ID, the proof of your banking details. That's the basics. Once you've got your account set up, you now need money in your investment account to invest, right? So then you need to
Yeah.
just EFT some money from your bank account into your investment account. So again, this can literally be as little as 100 Rand. Now that you have money
Mm.
in your investment account, this is where you actually start to buy and sell your shares. So almost all brokers will have an app. So Easy Equities, you would just go into the app. You would find the share or the ETF that you want to buy. Once you find it, if you're
Yeah.
happy with the price, then it's literally like you do in any app. You just click buy, and that's it. So the broker takes it from there. So the broker will take your instruction, they'll buy the shares for you, and then they'll place the shares in your account. And that's it. Like just like that, you're a shareholder. for, let's
Yeah.
say, 100 Rand even. I'm pretty sure you could do it for less.
Yeah.
So yeah, maybe just in terms of like how much money you need to invest. So this really is the reason why I'm such a big fan of easy equities, because when it comes to finding a broker that meets your needs, right? Certain brokers require a minimum deposit just to get started. And some
Yeah.
brokers will also charge a minimum brokerage fee per trade. So maybe they'll charge you 100 Rand just in fees per trade. But with easy equities, they keep things really simple. So for someone starting out, there's no minimum deposits. You can deposit any amount of money you have. And easy equities allows you also to buy shares for any amount of money because they use what's called fractional shares. Meaning even if you can't afford to buy one whole share, you can even buy a piece of a share. So like a share of a share.
Yeah.
And I mean, this is just so empowering for people starting out. I've literally bought 1 Rand 20 worth of shares before in my Easy Equities account. I'd received 1 Rand 20 in dividends and I needed to reinvest it. And literally, so I've tested this and I know you can buy a share for as little as 1 Rand 20. And then in terms of the
Yeah.
brokerage fees they charge, right, it's only 0.64%, meaning for every 100 Rand you trade, they're only going to charge you like 64 cents. So I think that's very achievable for any sort
Pretty
of business.
reasonable.
Yeah,
Yeah. Yeah. So then I'm just thinking about now in terms of once I now have my shares, once I have the money, sorry, in my accounts,
yeah,
and want to make that decision to invest. Uh, I've heard some people say if you don't know what to invest in, just invest in the products that you usually use on a day-to-day basis. So whatever it is, from cosmetics to health products to food to transport that you use, just invest in those companies if you don't know where to go. How do you feel about that? Or is there some other metric in which you would advise a first-time
sure.
investor to use?
So I think that's a great point, right? It keeps it really simple. And the principle behind that is it's saying that you should only invest in things that you understand. Okay, so if you don't
Yeah,
understand how a company works, if you don't understand what products they sell, what they offer, how they make their money, then really you should have no business investing in a company like that because you don't even know what you're investing in. Then you're just gambling, right? So I think
yeah,
that's a really important point, and that's maybe just a starting point in terms of narrowing down the list of options that you have. But for me, there are five key things that I look at when I'm assessing whether or not a company is a good or bad company. So what are those five things? The first thing I look for is a competitive advantage, known as a moat. The second thing I look for is the a demonstrated ability to consistently grow their profits. The third thing
mm,
I look for is does this business have strong cash flows? Okay, and then I look at is this business in a growing industry? And then lastly, and
okay,
probably most importantly, is what is the price of that business or the price of that share? And so, yeah, I'm happy to
yeah.
unpack those further if we want.
Please, please, could let's just start at the beginning. You said the first one is
Is a competitive advantage. Okay, so I'll look at a company and
okay.
I'll say,
What is a competitive advantage? Okay, cool.
cool. So let's take a step back. What is a competitive advantage? Uh, a moat is a barrier to entry which allows a company to maintain or grow their dominant market position. And a competitive
Okay.
advantage is something that gives a business power to set its prices of the products or service that it sells. Now, examples
Mm,
of this can be a particular patent on a technology or drug. So that's something that gives you the exclusive right to use that technology or drug and make money from it. Even something like a strong brand name like Coca-Cola is considered
yeah.
a competitive moat. If you think of Instagram, Instagram has network effects, meaning they've got like 1 billion plus users each month using their
Mm,
platform, meaning if someone wanted to be the next Instagram, it would take them an extremely long time to get to 1 billion users in order to really be a threat to Instagram. right? So that's the first thing I look at. Does the company have a competitive advantage or barriers to entry that can protect them? The next thing
Sure.
is, does this company have the ability to grow its profits each year? And this is something that's, it's an historical metric. So you actually need to look at the
Hmm.
company's financials over the last 5, 10, 15 years and see, has this company, number one, generated stable profits each year? But most importantly, has it been able to grow its profits every year, which is a lot more important. Well, why is this important, right? So this is important because it shows that the company has a good business model that works and is able to make money. And it also shows, for you as an investor, you are entrusting your money to the people who are running this company. And if the management team running that company are able to consistently uh, increase shareholder value year after year by making the right decisions and allocating capital toward the right opportunities within their business, then you can almost rest assured that this could be a good investment going forward.
So then how do you maybe think about the decision of a company such as Uber? To my knowledge, if I'm not mistaken, they aren't really a profitable company, but you could say they have that competitive advantage because I'm assuming that maybe all five metrics that you have, maybe you don't. Do you sometimes deviate a bit from them to say, okay, I see Uber, they have a lot of potential, but they are a relatively new company, so profit might not necessarily be something they're expecting within the next 2, 3, 5 years,
Mhm.
but maybe in the long term, to say 10, 15, 20 years, they are starting to look at, and maybe they're projecting to start making profits.
Yeah. So look, this is when we start getting into finance fundamentals. And so, I don't want to be a textbook on the platform because really
Yeah.
it's just knowledge for normal people.
Okay.
But essentially, what is a business worth? A business is worth all of the profits that it can generate over its lifetime. And so you want to know all the profits that the business can generate over its lifetime, all the cash flows. What is
I
that?
think I like that definition.
Yeah, exactly. So
Yeah.
what is that worth to me right now? So even though you might have a company like Uber, which for the moment might not be making any profit, and in fact is making deep losses because it's constantly reinvesting in its business,
Yeah.
if you are relatively sure of when in the future they will make profits, and if you are relatively certain about how much those profits will be, then it's something that can still be a good investment at the right price. So even if it doesn't have profits right now, but again, the key condition there is you need to know at which point in the
Price
future
correctly.
you're going to get those profits and how much those profits will be. Otherwise, it becomes too much of a gamble. And so I tend to shy away from stocks like that.
Okay. All right. Okay. Cool. All right then. I know you can continue with the next one.
So one of my favorite criteria to look at when I'm looking for a company to invest in is this company in a growing industry? And this is something that can really, really help you as an investor because a growing industry is a massive tailwind behind the company that you're investing in because what it means is the market that it's selling its goods and services into is growing. So maybe let's look at this through an example. Cloud computing is the new buzz. Businesses are
Sure.
rapidly moving to the cloud. They're adopting software as a service, which is based on cloud infrastructure. So Amazon Web
Mm-hmm.
Services, let's say it had a 30% market share of the industry, and the industry is worth $100 billion. That means it earns
Sure.
$30 billion in revenue. But if that industry is
Yeah.
growing so fast and that industry doubles to 200 billion, then if Amazon Web Services still has a 30% market share, all of a sudden its revenues are
It
60
doubles the
billion,
revenue as well.
right? It's double its revenues without much extra effort. It's still doing the same thing, but there's just a much bigger market for it. Even in a
Mm-hmm.
bad case where that company starts losing market share, it still has less market share of a bigger pie, which means you've actually still got a really good investment. And I mean, the double whammy is if you've got a growing company in a growing industry that's growing market share, then you've
And
really
better.
found a good thing. And I mean,
Yeah.
you did ask earlier, are there instances where I'll maybe let go of some of the criteria that I'm looking at. And so that comes down to point number five, which is the price that you are buying the company for is important. You know, you have to buy a company at the right price. If you pay more for a company than it's worth, then the returns that you expect are going to be lower going forward. If you buy a company for more than it's worth, in fact, it's going to take you a really, really long time to get your money back. Because remember, first, the value of the company needs to catch up to the price that you paid for it. And only after it's caught up to
Yeah.
the price you paid, do you really start, making money. So that's an important thing. The price is important. But every business has a price. If a business is selling at a really, really good price and is maybe lacking in one or two of those areas, but does still have a sound business model that generates good profits, and maybe the business is going to be under pressure in the short term, maybe because of COVID-19 or maybe a
Yeah.
legal battle that's ongoing, you know, at the right price, you can still get a really good return out of that company and still be compensated for the additional risk you're taking on by looking at that.
I think that's the biggest, that's the most difficult part
Mm.
out of those five metrics you just mentioned to determine what is the price, because obviously then it is a very
Subjective, yeah.
textbook calculation, you could say very subjective as well.
Mm.
Um, Determining what the price of a company is. And you always say buy a company that is underpriced or that is undervalued so that you can benefit from the increase. But what I've noticed also is that the stock market sometimes doesn't necessarily always fairly present a company's
Mm.
value, because it is based on people panic buying, panic selling.
Right.
Those are factors that come into play as well that might distort the price of what a company is listed at. But then we need to make sure that we understand the difference between the price and the value of the company, because then the
100%.
value of the company is now speaking to what I, as an individual investor, think, as you had mentioned before, the potential profits of this company over its lifetimes
Hmm.
are X. And that value, if I could say, not to get too technical, but that value today, what is that value for me today? And then the price on the stock markets is now, what is it actually listed at on the JSE or whatever stock exchange that we are looking at? Do you ever have, or have you ever gambled, I guess, on a stock where you see that this stock potentially is overvalued, but the market is not seeing it and just ride the wave? For example,
Mm.
I've heard some people cry and say Tesla is slightly overvalued, but that stock does not stop going up. So would you ever, or have you ever, um, ever purchased a stock like of that nature?
Yeah, so I think it's very important, and there's a lot of golden nuggets in what you've said. So, the share price that you see today, quoted on the market, I think we must understand that that share price is really it's something that represents everyone's expectations. Okay, so
It's an emotional number.
it's emotional, but it's also it can be emotional, but it always does represent people's expectations. So if you think the price is going to go up and I think it's going to go down, you think it's worth 50, I think it's worth 150. The stock market settles on a price of 100, which means it's balancing both of our expectations. I think that's something to keep in mind. Now, when it comes to emotions determine how many people feel really good about the stock market and how many people feel really negative and very fearful about it, right? And
Yeah.
the sentiment or the emotions behind the investors that are determining the market prices, that's something that's constantly changing, right? If people are just getting bad news left, right, and center, the economy is
Mhm.
closed down, the COVID cases are rising, international travel is closed, there's restrictions, then it's like all you're hearing is bad news, right? So then some investors
That.
just feel that, the future is so gloomy. And that's the type of thing that makes share prices come down. And if you're lucky, the share prices fall so much that they actually fall below what the share is worth. And so I think the important thing is what the company is intrinsically worth, so its actual value. It is a subjective assessment because it's based on your expectations of the story
Mm.
that you're telling yourself about the company that you're investing in. But I think the important thing is to not be so fixated on the value that you're attaching to your share that it stops you from investing, but rather
Mhm.
be self-controlled enough to know when the market is being or people are being too fearful, and then you can actually buy things at a discount. If you saw a jacket that you liked and you could buy it on sale for 70%, you would totally buy it. But if you saw that
Sure.
same jacket tomorrow selling for double the price, you wouldn't touch it with a stick. And then maybe just to speak about, Tesla and these stocks that just tend to shoot the lights out. Um, you know, it is possible for a company to be really expensive right now, but to still continue increasing in price each and every day for
Mm.
a long period of time. Now, that's something that in the market is known as momentum. It just means there's a lot of good news coming into the market. There's a lot of buyers who want to buy the share. And so they keep driving the price up, even though the share is already overvalued. There's a lot of interest in it. And so just that momentum, the fact that it keeps going up, makes more people want to ride the wave and be part
Mm.
of that upward rising share price. And that definitely can be an investment strategy. That's known as momentum investing. But understand you've got to be highly disciplined and highly skilled to follow that type of style. Because you've got to be able to identify when a company's got good momentum driving its share price up. And you've also got to know when to sell because with those high
Yeah.
flying companies, when the price moves so far away from the value, once the momentum goes away and people start
The markets will always correct
realizing
itself.
there's a big drop in share price at the end of it. So you don't want to be the last person running from the door. You've actually got to be one of the first. So I typically wouldn't encourage that type of investment strategy.
I completely agree with you. I think one thing that I've learned is not to be an emotional investor. And when I do invest, try as much as possible to invest in companies that I expect long-term growth in, as well as preferably a company that pays a dividend so that I can reinvest those dividends into the shares that I own. I guess maybe touching a bit on dividends. Touching a bit on dividends and dividend stocks, would you think that it's possible to live off dividends? And maybe if you could take us a step back actually and just explain what a dividend is before you get there.
Sure. So when you're investing in stocks, there's two ways you make money. The first way you make money is off capital appreciation. So that's the share price is growing, and so you're making a capital gain. The second way you can make money from investing in shares is through dividends. Now, when a company makes profits, a company can decide to pay out a percentage of its profits to its shareholders. That money you receive from the
Mhm.
company, that portion of the profits that you receive, that's what's known as a dividend.
Mhm. Okay, so if a company basically is not making profits, they're not going to be paying dividends.
Pretty much. And you're probably also going to see their share price going down. Yeah, because your
Okay.
share price follows your profits. So is it possible to live off dividends? The short answer is yes, but the long answer is that it takes a really long time to be in a position where you can live off your dividends. And let me tell you why. So living off dividends means that you aren't going to touch your shares, so you're not going to sell your shares. You're just going to leave them there,
Mhm.
and all you're going to do is you're going to take your dividends that you receive each year and you're going to use that to cover your living expenses. That's what it means to live off dividends. But if we look at
Okay.
something like the JSE All Share Index, which is the South African represents the South African stock market, the index would pay an average dividend yield of about 3 to 4%. And remember, this is an annualized figure, meaning 3 to 4% is all you can expect on an annual basis. So
Mm.
if your living expenses were 10,000 Rand a month, you would need 120,000 Rand a year in dividends in order to cover your expenses, right?
Yeah.
Okay, so
Okay.
if you need 120,000 Rand, in dividends. To work out the value of the investments that you require to generate those dividends, you take that 120,000 Rand and you divide it by the 4% dividend yield, and that equals 3 million Rand. So if you had 10,000 Rand a month of expenses, you would need 3 million Rand of investments right now. And that's a really tall order. You feel me?
Yeah, I definitely do. So basically, if I have, let's say, 20,000 rands of expenses per month, I need nearly double of
About
3
6
million,
million.
around 6 million.
Correct.
So you might as well not try not to live off dividends.
Well, okay, well,
You
look,
can get a better
let's
return on
not
your
be
money.
too negative, okay? Let me paint a scenario for everyone watching that can maybe be more of a positive note, okay? It is possible
Okay.
to build yourself a diversified portfolio of companies that pay high dividends. And a company that pays a high dividends would typically pay something around 8%. So here you're looking at things like property companies, banks and financial institutions, even your resource companies, they have very high dividend payout ratios. So in the good times, you'll get really good dividends from them. Okay, so let's say you could build a diversified portfolio of strictly focused on high dividend paying stocks, and you're getting a yield of 8%. For you to get 120,000 Rand a year of dividends out of that, that value of your investments actually comes down to only 1.5 million Rand. So that's maybe a little bit more achievable. But then that has to be your focus when building your portfolio, because you have to focus then only on stocks that pay a high dividend.
Mm, very interesting dividends, hey? Because I have read up a few on dividends that reads your real estate companies are the ones that generally pay out a high yielding dividends.
Yeah.
But what I've noticed is if you look at the growth over time of those shares, like the growth is not really there as much, maybe as other companies. Would you say maybe that's an accurate assumption?
Yes, that is accurate, but it depends again on what you're looking for as an investor. So the reason companies that pay out high dividends don't grow as fast as other companies is because in order for a company to grow, it needs to take its
Mhm.
profits and needs to reinvest them into new business, into expanding
Yes.
the business, into going into new markets and starting new products, and it then increases its profits by generating a higher return on its investments than its cost of capital. And so a company that reinvests and continues to grow and expand will grow its profits, and the value of the share
Mm,
price follows that. So that's where you'll get capital appreciation. But when it comes to companies that are paying out dividends, if a company is paying out, say, three-quarters of its dividends each and every year, it's by definition investing a lot less into expanding and growing its business. So
mm,
what that means for you is that you'll get a good dividend each year, but don't expect much from the capital growth because there's not a lot of money being reinvested into the company. But what you do want to look for if you are focusing on dividends is a company that is still able to grow its profits each year, because that means that your dividends
mm,
are going to grow each year. Just having a company with a good dividend yield now, it might pay, let's say, a 10% dividend yield now. But if a company can't grow its dividend at all, and you're not expecting
then it's
much capital
pointless.
appreciation out of that company, then it's actually a bad investment because inflation is just going to eat away your return. So you do need a company that's going to pay out good dividends and be able to increase its dividends each and every year.
Mm. So basically, like as you had mentioned before, the diamond in the rough here is trying to find that company that is in a growing industry, that is also growing itself and growing its profits, so that when the market share with the market, sorry, if that industry expands and they keep a relatively similar amount of market share, that they are able to benefit from that, because then their profits will grow, which will mean that their dividends will grow on a year by year basis.
100%.
Um,
That's it.
one thing I've always one thing I never want to do, especially at a young age, is to take those dividends that you get and because rather reinvest the dividends, don't you
Mhm.
think? Because in reality, the dividends for me and you aren't going to be a lot of money. Like, you're not going to get 100,000 rands in dividends unless you have a really large portfolio. If you have a relatively small portfolio and you get a dividend of 20 rand, in reality, what is 20 Rand? Rather just reinvest that dividend. It will benefit you in the long run because,
Yeah.
as we had said, investing for the long term, I think, especially from a young age, is very beneficial compared to trying to trade stocks, unless obviously you're experienced and that is your strategy.
Exactly. I think the important point there is when we are young, we have time on our side. And if you have time on your side, then compound interest is your friend. And so if
Mm,
you are drawing a dividend from a stock each and every year and you spend that dividend or you use it somewhere else, then essentially you're just gonna take the if you were to look at a fixed deposit, right? If you
yeah.
could decide, do you want to take out your interest income every year, or do you want to put that interest income back into the savings account where that interest can start earning interest? Then that's exactly the same way you should look at a share. If a share pays you out a dividend, that's like an interest payment. And if you want to earn
Mhm.
interest on your interest, then you reinvest your dividends back into the company or into another stock that might be growing even faster than the company that paid you the dividends. So yeah, I'm definitely
Mm.
in the camp that's in favor of reinvesting dividends for the long term.
Yeah, compound interest, a very
Compound interest.
interesting and term that is used to say that you only ever really see the benefits of compound interest if you are patient. If you are patient.
100%. That's true.
Yeah. So then, what? So would you say, for on that topic of compound interest, would you say that when investing in the stock market or any type of investment that pays out a dividend that pays out interest, when you reinvest, and you benefit from that compound interest, how long would it take you to, let's say, double your money?
Sure. So there's a really cool trick that I use, and it's you may have seen it if you've been on my blog, but it's called the rule of 72. So
I've probably read all your articles.
I appreciate it. So it's really cool. So in order to work out how long it'll take you to double your money, you need to know what the annual growth rate of your investments will be, or the compound growth rate. So
Sure.
um, uh, if you expect your share portfolio to grow by 10% a year, then you would just take
Hmm.
72, so the rule of 72, divided by 10%,
Hmm.
and that equals 7. So 72 over 10 equals 7. It'll take you 7 years
Okay.
to double your money if your money is growing at 10% a year compounded. If your
Mm.
money is growing at 5% a year, then it's going to take you a much longer time than it'll take
So
you
it's going to be
12
72
years.
divided by 5, whatever the answer to that is.
Yeah, it's like 12 plus years, probably more,
Okay.
14 years,
So
I
so
think.
basically, yeah, if you don't reinvest your money, then you will lose out on that potential on you potentially doubling your money in 7 years, assuming that the annualized interest that you'll be getting is 10%.
Yes. And look, if we look historically at the returns that one could expect from the stock market, historically, a stock market gives you a return of inflation plus 6%. So that could
Hmm.
be anywhere from 10 to 15% return a year. So really, if you are looking to compound your money and grow your net worth over the long term, then there really aren't better places to do that than the stock market. Because compared to all other asset classes like cash, like bonds, like property, um, uh, you get the highest long-term growth rate from stocks.
Mm. So then, is this when you say overall the stock markets? Is this now looking at it from like just on an average for all stocks
Yeah.
on the JSE, or is it maybe for okay, all right, I see. So then, how do then ETFs uh differ from the stocks, or is this also included in that averaging out of stocks?
Yeah, so for the person who's new to investing and wants to know what an ETF is, an ETF is an exchange traded fund. Now, all this is a basket of shares. So it's a basket of underlying shares. And when you buy an ETF, what you're buying is you're buying a share in this basket of underlying shares. So an ETF just represents a diversified basket of securities that you're buying. An
Would it
ETF,
normally be Sorry, I was just answering, would it normally be companies that are in the same industry or diversified also in industry?
So it depends, right? ETF investing is most commonly associated with tracking an index. So if
Okay.
you just want to get the returns of the stock market, then you could buy something like a JSE Top 40 index to track the South African stock market return, or the S&P
Hmm.
500 ETF to track the average market return of the US stock market. But that it's not restricted to index investing, right? Because an ETF can track an investment theme, an investment style, like style being momentum or value. It can track a sector, like just a group of resource companies or group of financial companies. There are all sorts of ETFs out there. And I think they really are wonderful building blocks for your portfolio. And that's definitely the starting point that I give to anyone who wants to start investing. I say buy an ETF first and then figure out the rest.
Okay, figure it out later. All right. So then I think maybe just one more question. Something that actually has even confused me when I've seen it on Easy Equities, I guess I didn't do my research onto it. It's the TFSAs. What exactly are those?
They are the greatest gift from the South African government to all the citizens, really. So a TFSA is a tax-free savings account. A tax-free savings account,
Hmm.
the best way to think about it is it's a box. Okay, this box is your investment vehicle. Okay,
Sure.
any investments that you invest in inside of this box. So any stocks, or you can't invest in stocks, but any ETFs or any bonds that you buy or any fixed deposits that you buy and you put inside of this box called a tax-free savings account, all of the growth from your investments is tax-free. All of the interest income you receive is tax-free. All of the dividends that get paid out to you are tax-free. And that's really such a powerful tool because for someone who's saving up for the long term, whether you're saving for
Hmm.
early retirement or whether it's for a long-term life goal, uh, being able to save on all of those taxes allows you to compound your growth even faster because you're not paying away any of that money to tax. You're actually just reinvesting all of it and allowing it to keep growing. So I really would
Is there
encourage
a limit?
everyone. Yeah, there are limits. So in each tax year, you can invest a maximum of 35,000 Rand into a tax-free savings
Mhm.
account. You can do this as a
So-
lump sum, so you can put a whole lot of money in there at once, or you can put
Yeah.
money as and when you have. You could maybe put in 3,000 Rand a month, and do it that way.
So then, but then isn't there, if I'm not mistaken, a lifetime limit as well of like 500,000 rands?
Yes, that's 100% correct. There's a lifetime limit of 500,000 Rand. But if you consider the fact that you can only put in 33,000 Rand a year, I think it'll take you something like
Mm.
13 years to reach that 500,000
That
Rand
limit.
lifetime limit. And, maybe we can hold thumbs and hope that, as time goes by, the National Treasury will be very kind to us and will increase that 500,000 Rand
Yeah.
lifetime limit. So, I mean, that's something
Yeah.
we should really hope for and ask Uncle Tito to help us with.
There's something that I always used to ask myself, I guess when I was studying, was regarding the lifetime limits and to say, okay, on the TFSA, you now have this vehicle that is basically in essence tax free
Mhm.
to certain limits. But on the other hand, as well, when I get paid out dividends, I'm thinking, well, dividends are also tax exempt. Interest is also tax. What there's a deduction or something for it for interest to a certain portion, a certain limit as well. So then, what is really the benefit of me going through the tax-free route rather than just investing in a stock that's going to pay me a dividend that's going to be a tax exempt anyway?
No, so that's wrong, right? Okay, dividends are not tax exempt, and so this is the thing,
Okay.
right? A lot of people don't actually spend enough time considering the tax implications of the investments that they get into, whether it be putting money in a bank account, whether it be investing in the stock market, whether it be buying a property. People don't take into account the tax implications. When it comes to investing
Mm.
in shares, there's two taxes that you need to be worried about. First is dividends tax. Okay, every time a company pays you out a dividend, the company keeps 20% of that amount and they pay it to the tax man for you. So that's called dividend withholding tax, and that's 20%. So if a company was paying you
And they
100
recently
Rand,
increased it, eh?
yeah, so if a company is going to pay you 100 Rand in dividends, you're only going to get 80 Rand of that. Okay. The second thing you need to worry about is capital gains tax. So if you buy a share and over time the value of that share increases, let's say you bought share at 1,000 Rand and the value of it when you sell it is 2,000 Rand, you've made a capital gain or a profit of 1,000 Rand. So what SARS does is it says, I'm going to charge you a capital gains tax because you've now made money. So 40% of that tax gets included into your taxable income. So of that 1,000 Rand profit, 400 Rand gets included into your taxable income. And then that gets taxed at your marginal tax rate. So if your tax
Yeah.
rate was, say, 45%, then your effective capital gains tax would be about 18% on that. So if you just look at those two taxes, right, you're paying 20% or 18% effective capital
Dividend.
gains tax, and you're paying 20% dividends tax. That means you're essentially giving away 1/5 of your investment earnings to SARS. But with a tax-free savings account, you now get all of your money. If you get dividends in your tax-free savings account, you're not paying tax. You can have unlimited capital gains in your tax-free savings account and you don't pay tax. And even when you withdraw that money eventually out of your tax-free savings account, you don't pay
You want
tax. It
tax.
really is a no-brainer.
I guess it is better to just do both, eh? Because you will hopefully reach that limit one day. And when you reach the limit and get into the portion when you are being taxed, you have been investing on
Mhm.
in different types of shares that potentially could have given you higher capital growth as compared to your tax-free savings accounts. I think
Yeah,
that's something personally that I'm doing because I do realize
as
the
well. Yeah.
benefits of investing in tax-free savings accounts. Like it's so difficult to pay SARS. Like I always
It
find
just
it so
doesn't feel
difficult to
right.
pay SARS.
It's
it's
painful.
like, but you weren't there. But you weren't there when I was sitting down, crunching the numbers, thinking about which share to buy. When I
Uh-huh.
lose, I guess fine, fair enough. When you lose, you do get those capital losses as well. But when you're having gains, like SARS, you weren't there. You weren't there when I made these
That's it.
decisions, and now you wanna cut off my pie.
Look, I think
Yeah, it really.
so. I know this isn't like a tax conversation, but I think this is just a
Yeah,
principle that I would like all people to understand, just in general, is that firstly, when you are making investments, especially investments for the long term, you need to understand what the tax implications are. Because two investments might both offer you a 10% return, but one investment might be taxed a lot more than the other. So those two investments, while their returns look equal, after tax, the returns aren't equal. So that's the first thing. I think people
yeah,
need to be aware of different tax implications. And yes, I know it's a lot, but spend the time. The second thing is you realize that people who have earned a lot of wealth over their life have made most of their money through capital assets. So from capital growth, so investing in the stock market or buying a property and selling it for a big profit in the future, or starting a business and selling that business for profit in the future, not by not necessarily by working their whole life. And the reason for that difference is tax. Okay, if you were one of the top income earners in South Africa, you pay 45% tax rate, meaning
off
from
the bat.
January until sometime in the middle of May, you are working for the government, and the government is getting 45% of your earnings. So you're only getting, 55% of that earnings. But if you are making your money from capital assets, and even if you are at a 45% tax bracket, your maximum effective capital gains tax on capital growth is 18%. Okay, so you actually get to keep 82% of the money you make versus uh, only getting income from your job.
55.
So that's just something that I think everyone should understand. As scary as taxes are, it'll make a huge difference over the long term to understand.
Yeah, definitely. I do agree with that. you don't want to work half the year, basically. You're working for the government half the year, and then the other half of the year, only then are you actually really
Starting to
working
work
for
for yourself
yourself
and put
and
money in
your
your own
family
pocket.
to
Yeah,
enjoy. Yeah, when you put it in that perspective, it's like, yo, 6 months, an entire 6 months has just been given away of my life.
yeah,
But yeah,
it's
I
crazy.
understand. So lastly, would you say maybe give us a quick three tips that you just give to someone who is starting out in investing and is looking to grow? Just a
Mhm.
quick summary maybe of the key points that you believe, those three key points that someone who would be leaving this conversation or who has joined us late in this conversation to
Sure.
say, what are three things that they should consider?
So the first point is get started because time is on your side and investing in stocks is really not as difficult or as expensive as most people think it is. The second point is invest in ETFs that track the market. So invest in an ETF that tracks the index because most investors, even professional ones, can't consistently beat the market over the long term. And by buying an ETF, you already have a low cost exposure to the broad market and you're fully diversified. So that's the second thing. And then I think the third point that I would take away from this is investing in stocks is for the long term. Don't expect to be in and out. Okay, if you're investing in stocks, I would say a minimum of like 3 years, but really the majority of the money is made over the long term, so over 10, 15, 20-year periods.
Definitely. Okay, great stuff. Thank you, Keelan, for joining us today for this conversation. I
Sure.
think it has been very insightful. And I guess if anyone wants to drop you a DM, is that okay? They can drop you a DM asking some investment questions
Absolutely.
on your page.
Absolutely. You can follow
All right.
forinterestsake.com on Instagram, go on the website forinterestsake.com, send me an email forinterestsake.com at Gmail. Yeah, I'm more than happy to answer your questions.
Oh, great stuff. So you said the website is for interestsake.com as
Yes,
well as the Instagram handle. Okay,
correct.
great stuff, guys. So if you do have any other questions about investing in the stock markets, I'm not an investing professional in any way. I'm just a random guy on Instagram that is now having a conversation with Keelan, and I truly do appreciate it. And I'm sure everyone seeing the comments as well, everyone is really appreciating your insights into investing in the stock markets. Thank you again for joining us this evening, Keelan.
Thanks, Nhlakanipho, and thanks everyone for joining us.
Great stuff. Cool. Cheers.
Cheers, everyone.
So that was Keelan who was joining us for today's session. I hope that everyone has gathered a lot of knowledge from today's session. I do get a lot of questions sometimes about investing in the stock market, and I'm more of a property guy. I do invest in the stock market myself because I do believe in diversification, and I believe that investing in the stock market is truly for the long term. So if you do have any questions, do follow forinterestsake.com on Instagram. He's also on LinkedIn and he has many articles on LinkedIn. You can find him. He's Keelan Potier. Sorry if I pronounced that incorrectly, but yeah, he has many articles and very informative information about personal finance, about investing in different types of investments. And personally, I've learned a lot from reading his articles. So if you are interested, do follow his page, do go onto his website, drop him a DM. If you are interested in anything that he has to say, share, or if you have a personal question about investing that I can't answer, then feel free to drop him a DM. Anyway, thank you very much. Take us through property, please. I will take you guys. I'll be having another live next week in property. If you have any questions, I probably missed your questions. I'm really sorry. Just drop Keelan a question. Just drop Keelan a DM, and I'm sure he'll be interested in assisting there. I'll be having another live session next week. I'll be having another live session next week with a property investor, and that session is also going to be hopefully as informative as this. I'm going to be trying to do this every single week to bring you guys as much value as possible. Anyway, thank you very much again for being with me this evening. Enjoy the rest of your evening. Cheers.